In this week's market update, a busy few days for the UK with a string of blue chip results, the budget and Super Thursday. US earnings season continues with more big tech names reporting, and market jitters continue as a scary October draws to a close. It's a big week for the UK, with yesterday's budget grabbing the early headlines to be followed by a raft of leading companies announcing results or trading statements, and then it's Super Thursday, the quarterly combination of Monetary Policy Committee meeting and inflation report. The budget was, as usual, more of a political and economic event than a strictly important market one. The economics were a bit better than expected at the time of the spring statement. The Chancellor ended up with about £13 billion more than he thought, thanks to higher tax receipts and lower spending. That enabled him to indulge in a modest giveaway budget, the first real piece of good fiscal news in the 8 years of the current government. Inevitably, however, this was primarily a political event. The giveaways themselves were largely there to shore up the Conservatives ahead of the key vote on Brexit in a matter of weeks, and the possibility of a snap general election next year. There were lots of measures, mostly inconsequential in financial terms, designed to both please backbench MPs and persuade them to back the Prime Minister's soft Brexit plan, and to soften up the electorate. Given the limited hand he had to play, the Chancellor actually did a good job. He was able to deliver the PM's promised expansion in the NHS's budget and to indicate that the last 8 years' austerity is ending, if not quite ended, as Theresa May rashly claimed at the Conservative Party conference. The good news for investors was that their pensions were left alone. It's becoming a pre-budget tradition now to forecast a raid on the UK's pretty generous pensions tax regime. Ahead of the Brexit vote and the election, whenever that comes, the Chancellor sensibly didn't risk it though. Possibly more relevant to markets than the budget will be this week's collection of blue chip corporate results. Announcements from the likes of BP, BT, Next, GlaxoSmithKline, Reckitt Benckiser and Glencore will shine the spotlight on the out-of-favour FTSE 100 index, which failed to track the high-flying US market on the way up, but has kept pace on the way down, despite yesterday's reasonable rally. Having fallen by around 10% during the recent market correction, the UK's blue chip index now yields more than 4.3%, with many leading shares yielding easily more than 5%. The average multiple of earnings on which a FTSE 100 company trades is little more than 11, compared to about 16 for leading US shares. Although this reflects significant uncertainty around Brexit and the subsequent outlook for the UK economy, there's a growing contrarian case for UK shares at these valuations. Some of the highest yielding shares are reporting this week. BP returned to dividend growth 3 months ago, and there's little reason to think that the outlook has deteriorated during the past 3 months, in which the oil price has been as high as $86. Also on the high yield list is BT, due to report on Thursday, although here the dividend is probably less secure following the announcement of Philip Jansen as the company's new chief executive to replace Gavin Patterson. BT pays out around 3/4 of its after-tax earnings in the form of a dividend, and the fear is that the new boss may well think he has better uses for the cash as he attempts to get the company's shares back on a growth path. Retail is also in the spotlight this week, with figures due from Carpetright and Next. Carpetright looks to be in the worst part of the retail sector, a high street store dependent on a healthy housing market. Next, on the other hand, although not immune to pressures on the high street, is doing its best to keep up with the move online. It sells more via its website than through its shops now. Then on Thursday, the final piece in the UK jigsaw this week will be the Bank of England's interest rate announcement and its projections for growth and inflation. It would be pretty surprising if the bank did anything other than sit on its hands this week. Although interest rates remain near rock bottom at just 0.75%, there's no reason for the bank to tighten the squeeze further on a UK economy that's struggling to grow through a period of intense Brexit uncertainty. Although inflation is marginally above the bank's 2% target, there's scant evidence that prices or wages are in danger of rising fast. With the outcome of last-minute negotiations before next March's departure from the EU still unclear, the bank will prefer to wait and see. Central banks around the world are likely to remain cautious while stock markets continue to be volatile and weak. Last week, we saw another period of uncertainty for investors, with an added frisson this time provided by the fact that for the first time in a long while, there appear to be few places to hide. Almost all asset classes are now in negative territory for the year, with even the robust US stock market and high-yield bonds succumbing to the latest bout of risk aversion. The S&P 500 briefly fell into correction territory at the end of last week, and again in a roller coaster ride yesterday, a fall of more than 10% from the recent peak. Other markets are firmly in bear market territory, usually considered to be a fall of 20% from the latest high. First and foremost among the bears is China, where the CSI 300 has fallen by more than 10% in October, including 3% yesterday, and 24% for 2018 as a whole. In China, the combination of slowing growth and trade war fears is proving toxic for investors. This week, a leading consumer stock, the luxury spirits maker Kweichow Moutai, fell by the maximum daily limit of 10% after announcing a slowdown in third quarter profit growth. Apart from in China, investors do not yet seem to be panicking. In the week to last Wednesday, US equity funds actually took in $1.8 billion as some investors decided that the recent falls represented a buying opportunity. Even in emerging markets, which have borne the brunt of the sell-off this year, currencies and bonds have recovered from their lows, even if the good news is yet to reach shares. European markets received a boost at the beginning of the week after a Bloomberg story said the Chinese authorities were considering a 50% reduction in the tax on vehicle purchases. German car makers like Daimler and BMW led the charge. Italy added to the good news with a 2.4% gain after S&P made no change to the country's investment grade rating. That's welcome, but broadly the mood remains risk off. Investors are looking for reasons to sell rather than stepping in with much enthusiasm to try and catch the bottom. And they're finding plenty of reasons to worry. As well as the usual interest rate, growth and geopolitical concerns, the new fear stalking the market is peak earnings. Investors are looking at results from the likes of Amazon and Google owner Alphabet and focusing on any signs of slowing growth. Those tech giants built on earlier gloomy reports from industrial bellwethers like Caterpillar and 3M, which suggested that rising costs are starting to crimp profitability. With another 140 US companies in the S&P 500 reporting this week, including Apple and Facebook, we should have a better picture of the earnings outlook by Friday. Typically, when shares start to wobble, investors can find a port in the storm with bonds. This time, however, the combination of rising interest rates and potentially slowing earnings is providing a headwind for both asset classes at the same time. This makes asset allocation particularly difficult. Now, whether the Federal Reserve will resist the urge to continue tightening policy in light of the market turbulence may become clearer at the end of the week when the monthly non-farm payroll employment data shines a spotlight on the health of the US jobs market. The expectation is that 189,000 jobs were created in October. That's up from 134,000 in September. And with unemployment holding steady at 3.7%, the lowest level since the 1960s, there's little reason for the Fed to change tack. It would probably take more than a bit of criticism from Donald Trump and a 10% fall in the stock market for the Fed to change its mind. Meanwhile, and finally, politics is casting a long shadow over markets around the world, with big changes afoot in Europe and Latin America. At the weekend, there were elections in both Brazil and Germany, and they delivered important results. In Brazil, the election of former army captain Jair Bolsonaro ushered in a dramatic shift to the right, the first far-right administration in South America's largest country since its military dictatorship ended 30 years ago. Elected on hopes for economic reform, Bolsonaro offers a market-friendly but authoritarian and illiberal administration. He's spoken approvingly of the 1964 to 85 military dictatorship and disparagingly about minorities. Yet another country has now fallen under the sway of an autocrat with a desire to make a dramatic break with the past. And meanwhile, in Germany, Angela Merkel's decision to stand down as leader of the Christian Democratic Union after a disastrous regional election in Hesse marks the beginning of the end of her 18 years at the top of her party and 13 years as Chancellor. Although she remains in charge of the government, it's hard to see how long that can last, as her authority in her own party has drained away following her principled and compassionate but unpopular welcoming of refugees in 2015.